What's up, ladies and gents? This is Joey Z bringing you another monthly market update. I don't know why I did that. The theme of this month is hope. Hope. We're starting to see some signs of some of those pressure valves that are bringing this market to a fever pitch being released. Just a smidge. So let's get into it. Let's talk about inventory. One of the key questions for 2021 is, will inventory increase as the pandemic subsides, or is it going to decrease even further? So tracking inventory is going to be very, very important this year. And it's finally starting to tick up, although demand still remains incredibly strong. So real quick on prices. According to Altos research, the median price of single-family homes in the U.S. stayed flat this week at $399,000. The market is past the normal peak pricing time of the year, and so Altos expects that prices are going to stay under $400,000, ticking down just a bit for the rest of the summer, which is normal seasonal behavior. But as we all well know, this isn't exactly a normal time. So we'll see about that. So inventory climbed another 3.8% this week to 342,000 single-family homes that are unsold, active on the market. A week ago, that number was 329,000, which means we're up 4% since last week, and we're up 11.6% from the bottom that we saw in early April. So it appears that inventory has bottomed and inventory is on the rise. However, we're still at 51% fewer listings than last year at this time. Overall, though, last year inventory was falling by a couple percent per week. Now it's climbing, and every little bit of inventory helps in this market. So Altos Research is calling this the new normal for the real estate market, in that it would take several years of significantly higher interest rates and vastly improved new construction to get us to anywhere near the old normal of 1 million or so homes on the market. How many years? Well, according to a report by the National Association of Realtors featured in this article by the Wall Street Journal, to shrink the supply deficit, builders would need to exceed the long-term historical average pace of 1.5 million units per year. U.S. builders added only 1.225 million new housing units on average each year from 2001 to 2020. So that figure is down from an annual average of 1.5 million new units from 1968 to 2000. At 2.1 million units a year, near the level reached in 2005, it would take a decade to close the gap of 5.5 million units, which is the number of units that we are short of to meet long-term historical levels. And last year, our best building year since 2006, we put up only 1.38 million. So we got a lot of building to do. Now, with that said, housing economists differ in their estimates of the supply shortage. An earlier study from Freddie Mac estimated a shortage of 3.8 million units, and John Burns Consulting estimates that number to be fewer than 1 million homes, stating that our adult population isn't growing as fast as it used to and that we don't need to build as much as we used to. As the total inventory inches higher, the number of listings that go immediately into contract stayed the same this week at 24,000, so these are listings that take offers and they go into contract essentially immediately after listing. And then we had 80,000 new listings coming into the market and spending at least a week. So here's what this says to us. It says that demand backed off of that peak of the frenzy that we saw in May, but it's not continuing to decline. So if your house comes to the market and it's priced right, obviously it's still going to move very quickly. Let's talk about lumber, everybody's favorite topic these days. So we saw in April that housing starts took a step in the wrong direction and tumbled 9.5% to a seasonally adjusted annual rate of 1.569 million units, according to the Commerce Department, and then did slightly better in May with 1.52 million, but this is compared to 1.733 million units in March, which as of right now remains the highest level that we had since June 2006. So a big factor in this drop was the soaring prices for lumber and other materials, as everyone is aware of. But it appears, according to this article by the Wall Street Journal, that lumber prices might finally be coming back to earth. So both futures for lumber and cash lumber prices are dropping pretty significantly. Futures for July delivery ended Monday at $996.20 per 1,000 board feet, which is down 42% from the record of $1,711.20 reached in early May. Futures have declined 14 of the past 15 trading days. Cash lumber prices are also crashing. So the pricing service Random Lengths said on Friday, June 11th, that its framing composite index, which tracks on-the-spot sales, dropped $122 to $1,324, which is its biggest ever weekly decline. Up to now, builders have been jacking up home prices, and many have stopped pre-selling houses before the studs were installed, as they previously did, because they were afraid of misjudging costs and selling too cheaply. So according to the article, the rapid decline suggests a bubble that has burst, and the question now is how low lumber prices are going to fall. With that said, even after tumbling, lumber futures are still nearly 3 times what is typical for this time of year. So lumber producers and traders expect that prices are still going to remain relatively high just due to the strong housing market, but they're optimistic that the supply bottlenecks and this type of crazy, frenzied buying that has characterized the economy's reopening and that has sent prices to the freaking moon, and multiples of old all-time highs are finally starting to wind down, which is in line with the uptick in inventory that we just talked about a few minutes ago. The article showed projections for 2021 ranging from anywhere from a low of $447 per thousand board foot to a high of $800, which is more in line with the pre-pandemic record of $639. But whatever it is, it looks like peak lumber prices are in the rear-view mirror. Thank the lumber gods. Second home prices are also cooling down. Redfin has said that the second home market appears to be cooling, although annual sales, which are measured by mortgage rate locks, were up nationwide by 48% in May. But the company says that while that year-over-year increase is obviously substantial, it's the first time in a year that annual growth has fallen below 80%. With offices reopening, life returning back to some semblance of normality, people are a little less focused on fleeing to that beach or to the lake. But beyond that, there's also the government-sponsored enterprise factor, Fannie Freddie. The mortgage lending rules for second homes as well as investment properties had tightened in April and May due to changes in Fannie Mae and Freddie Mac's agreement with the Treasury Department. Second home and investment property mortgages can now make up only 7% of a lender's total pipeline. So less access to capital and higher rates that the lenders are now forced to charge for investment loans and second home loans as a result of these rules have driven some of that demand down. Inflation, we got to talk about it. Everybody's talking about it. All the cool kids are talking about it. So for the third month in a row, year over year, inflation came in higher than expectations at 5% versus the expected 4.7%, which this is the largest uptick in inflationary pressure since August 2008. And we all know what happened a couple months after that. But economists say this time is different from the Great Recession or the hyperinflation that we experienced in the 1970s for several reasons, which are a little beyond the scope of this video, but in general, the largest drivers of the 5% year-over-year inflation figure are from categories that were hit particularly hard during the pandemic, like used cars, trucks, etc. So I'll give you a quote from Eric Winograd, senior economist at AllianceBernstein. He said, "The more persistent categories of inflation, the ones that do a better job of capturing the sustainable trend, are significantly more subdued. That means that the details of Thursday's print," not sure exactly what he's referring to there, "continue to support the idea that the spike in inflation is transitory." There you go. So the market is clearly listening to the Fed and other economists because traders just stiff-armed all that information revealed in last Thursday's CPI report and brought stocks to a new record high last week. However, this week, the Fed has now officially signaled that they expect to raise interest rates by late 2023, which is sooner than they anticipated in March. So that is pretty big news and something to keep an eye on, and a signal that inflation is perhaps creeping up a little faster than initially anticipated. Next up, things are looking good on the home equity front, obviously, with prices rising this high. But a CoreLogic analysis showed that U.S. homeowners with mortgages, which is roughly 62% of all properties, have seen their equity increase by a total of nearly $1.9 trillion since the first quarter of 2020, which is an increase of 19.6% year over year. This is an average annual gain of $33,400 per household. So in the first quarter of 2021, the total number of mortgaged residential properties with negative equity decreased by 7% from the fourth quarter of 2020 to 1.4 million homes, or 2.6% of all mortgaged properties. On a year-over-year basis, negative equity fell by 24% from 1.8 million homes, or 3.4% of all mortgaged properties in the first quarter of 2020. So this means that 450,000 properties emerged from negative equity during the year. This buildup of equity has also become super duper important to homeowners who are deciding on their post-forbearance options. See, in the previous financial crisis, many borrowers were underwater, and borrowers today who are behind on their mortgages can tap that equity and sell their home rather than lose it through foreclosure. If home prices increase by 5%, which they will, 195,000 homes would regain equity. If home prices decline by that same percentage, 260,000 would fall underwater. Another good sign is that for the first quarter of 2021, the net equity extraction, or the amount of equity that people tapped into from their homes via cash out refinances, was $41 billion, or just 0.8% of disposable personal income. This is nothing like the equity extraction that we saw during the housing bubble as a percentage of DPI. Forbearance is looking good too. So the number of loans in forbearance declined by 61,000, or 2.9% during the week that ended in June 8th. Black Knight said that 2.06 million loans remain in forbearance programs, 3.9% of all active mortgages. The company says that what happens in early July will largely dictate the future of the program, as many of the plans enter their final 3 months of the forbearance protection. Credit access, this is interesting too, so check it out. The Mortgage Credit Access Index, the MCAI, which is the Mortgage Banker Association's measure of credit availability, rose 1.4% in May to a 129.9 reading. All that means an increase in the index indicates a loosening of mortgage underwriting standards. But look at the chart. The index is still around half of where it was in February 2020. Lending standards are still tight. We're not in a credit boom. A credit boom happens when lending by financial institutions expands at a rapid pace, and usually it's a result of strong macroeconomic performance, high asset prices, high rates of investment, GDP growth, all that good stuff. They're usually risky and followed by financial busts and economic slowdowns. And I repeat, that is not what's happening in this housing market. In fact, lending standards are about as tight as they've ever been. These home price increases are a result of demographics and lack of supply. We just have a little bit more buyers coming in, just more people who want to buy homes. Did you guys know that over 50% of adults between ages 18 to 29 are living at home with their parents? It's crazy. But all that's changing. See, millennials made up the majority of all home purchase applications for the first time in 2020 at 54%. We are moving out of mom's basement and we're taking over the housing market. Millennials represent the largest age cohort since the baby boomer generation, and they are entering prime time home buying age right now. Actually, the median age millennial is turning 30 this year. It's me. I'm literally the average millennial, and I just bought a house last week. Damn, I'm so predictable. Yeah, demographics works like that. So overall, guys, I'm definitely bullish on real estate over the next couple of years, given the cheap debt, the lack of inventory, the demographic shifts we're seeing. And it's not just because I work in real estate. I wouldn't have bought a house if I wasn't. I mean, my rate was 2.75%. Come on, dude, that's free money. And I'm hopeful. I'm optimistic that the pieces that are going to be needed to move us into a healthy equilibrium between supply and demand are slowly but surely falling into place. So I hope you guys enjoyed this update. That's it for now, and I will see you when I see you. Peace.